So, hello on this beautiful spring day. We're talking commodities today, energy, metals, the lot. And this past week has been quite some wake-up call. And I'd love to be able to say I called the top last week. I didn't, but I kind of did say that it was a very real possibility. This is the kind of excess that marks a top, was one thing I said, and more besides. But what can I say about this correction? Oof. Starting with gold, we got the feared double top at $20.70 an ounce, and that was followed by a so-called island reversal pattern, and that's very bearish if you subscribe to such hocus-pocus technical analysis. And gold duly headed lower, and it held for a bit around another historic price point, 1920, the old 2011 high, but the momentum took it downwards into the 1800s. And since when it's bounced, it's now at 1940. Now, don't try and make sense of gold. Gold should be going higher. War, inflation, all the rest of it. Crikey, the planes have come out, and now somebody's come out with some kind of axle grinder up the road, ruining the spring tranquility. But hopefully you can still see me. But yeah, you can still hear me. But as I was saying, gold should be going higher. But how often do we observe an enormous gulf between what gold should be doing and what it actually does? None of this is helped by falling stock markets, which create a general sense of unease, not to mention liquidity drains. The other precious metals, silver, platinum, palladium, all saw similar about turns, with the PGMs, the platinum group metals in particular, experiencing vicious selling. Platinum lost over $200. Palladium lost over $1,000. Now, I've no idea where the world suddenly thinks it's going to get its palladium from if Russia is out of the equation. But speculative excess is speculative excess, and it trumps fundamentals, at least in the short term. Base metals were similarly struck down. The spikes up in copper, aluminium, zinc, iron ore and lead all reversed, and the base metals have mostly returned to their breakout points. We got the Federal Reserve announcement yesterday, and they're all creeping back upwards. As for nickel, who knows? It seems you can't even trade nickel. The fundamental case for higher metals prices remains. Even without this war, many years of underinvestment were leading to supply shortages, and hence this ongoing bull market. The war triggered panic, it triggered frenzy, and that's why we got those spikes. Now we've had the washout. We probably need a settling period while markets find their feet, and we can reassess. There'll be a bounce, a dead cat bounce. Is this the dead cat bounce now? But the burning question is whether we now head into a bear market, and my instinct is that we don't. Although where prices find their floor will tell us a great deal. We're getting the bounce now. How much spring will that bounce have? That'll tell us a great deal. Turning to oil next, Brent flirted with $140 a barrel before flipping on a dime and falling back to about $95, $45 correction, crikey. I think Russia is still supplying oil, but the narrative is now that emerging that we need to stop relying on, how shall I put it, nations with insalubrious governments for our natural resources. Prime Minister Boris Johnson was articulating just such thoughts in the Telegraph this week, and he's now coming under increasing pressure to ignore green pressure groups and develop domestic oil and gas reserves. Nigel Farage has just started a campaign on this very subject. In the US, all President Biden seems to be able to talk about is high gas prices, be it actual gas or the stuff more properly known as petrol. And one wonders if his anti-domestic development policies will also do an about turn, and America will try to regain its heady days of only a few years back when it was self-sufficient, energy self-sufficient. It could meet all its oil and gas needs without having to rely on imports. The anti-domestic development narrative is looking a lot less compelling in the face of the Ukraine invasion, and it can only be losing popular support, although I can't pretend that my finger's on the pulse in America. And this all points to increasing investment at home, and that should be good for all natural resource companies in sensible places. There is a growing need for products and services, such companies are providing, and there will soon be the capital to back it up. On the other hand, there is also a growing demand for windfall taxes on energy companies, especially in the US. Even with this correction, I suggest, and by the way, I don't necessarily count United States as a sensible country. You only need to look at what happened to Trilogy Metals. That was a company that had its permitting just revoked for no apparent reason after it had spent 5 years negotiating them and agreeing them. So the US is not that safe a place for natural resource companies. But even then, with this correction then, I suggest you should remain long energy and mining companies in sensible jurisdictions. And as I say, the US, with some of its recent rulings, does not necessarily count as sensible. Or take this opportunity that we're going to have over the next few weeks to accumulate some positions and get long if you are not already. One observation is that the companies have not sold off to the same extent as the commodities themselves, and that implies that a disaster of the secular bear market variety just starting is not yet at hand for commodities investors. There's still some gas in the tank, so to speak. As always, I reserve the right to change my mind as events unfold. I change my mind all the time, as regular viewers will know. But for now, my prognosis is that what we've just experienced is a correction of the massive washout in a bull market variety rather than an end of days secular top. What do you think? Am I right? Am I wrong? Post your comments below. But I shall be watching prices, reading Twitter, listening to cleverer people than me on podcasts, and I guess thinking avidly this week and trying to do so with an open mind. This is one of those times that requires thought, but probably not yet necessarily huge action in the sense of liquidating positions. Anyway, onwards we trudge. Thank you very much for watching. Please subscribe to the channel. Look out for my Substack channel. I'll post a link to that in one of these windows here or in the comments below, and I'll be back with another video very soon. In the meantime, cheerio.